This is day 29 of me building a crypto personal brand in public until I hit $1 million in revenue. So how these videos normally work, so there are three parts of them. First, I'm going to be responding to a bunch of questions and comments that I've got from X, YouTube, and also my DMs. Then I'm going to be doing a progress update. So this is just me sharing what am I actually doing today, right now, in order to move closer to this goal. And then I'm also going to be publicly sharing my strategies, tactics, and just some extra thoughts as I move closer to this goal. All right, let's get started. So I actually have a lot of questions to go through. So let's start powering through all of them. All right, so just real quick, since all of these questions actually came from my DMs rather than my comments, I'm actually going to be keeping them anonymous today. But if you guys send in a question via like a comment on one of my X posts or a comment on a YouTube video, then I'll feature your name. But if you send the question in via DM, I'm just going to keep it anonymous. All right, so question one, how tight or wide should my stop losses be? So here's my take on this. I want the stop loss to be as tight as humanly possible, right? Because the tighter it is, the less like the less price has to travel against you before you have to go and cut the loss. Like in an ideal world, if your stop can be one tick wide, that would be perfect. But realistically, we can't do that. So as tight as realistically or ideally as possible. But also, we need the stop loss, or at least I need my stop losses wide enough such that if my trade idea gets invalidated early, I can at least cut the trade before the stop loss is hit. So it has to be tight enough to the point where after fees, the strategy can still be like after fees plus slippage, the strategy can still be profitable. And it has to be wide enough so that I can at least have the option to exit the trade early for a loss before the stop loss is hit in case the idea gets invalidated early. Okay, so that's the theory. Now let's actually take a look at a chart. By the way, this is not a real trade. I'm just showing this for example's sake. So I did not actually take this trade. So my rule of thumb is I like to have the distance from the entry to the stop loss somewhere between the range of like 5 to 15 candles wide. So like the average size candle, right? So if we look at what is the size of an average sized candle? That's one candle, right? So if we that's one, that's two, that's three, four, five, six, seven, right? So no, like not smaller than roughly five of these candles. And by having a stop roughly this wide, like 10-ish, like somewhere near that mark, roughly 10-ish candles wide, that will give me enough opportunity to cut the trade early if things do decide to go south. That's just talking in terms of candle distance. If you want to take it like just another simpler approach of looking at it, I like to have at least one support or resistance level on the way to my stop loss. So my stop loss has at least one level on the way there, such that if I enter the trade and then it's not looking good, and then I get a candle close below that FTA, first trouble area, if I get a candle close below my FTA, I can then say, oh, this trade isn't really looking that good. I think that price is going to continue and hit my stop loss. So I'm just going to play it safe. I'm just going to market close out of the position. I'm going to get slipped a little bit on that as well. And at least I can exit the trade somewhere here instead of somewhere here or even slightly under this point after slippage, right? So in simple terms, or trying to keep the answer really simple, roughly 5 to 15 candles away, or just the second, somewhere near the second swing low, right? Because if I have a stop loss which is like super wide, like super wide, then it's just way too wide, and I'm going to be stuck in the like just a 1R trade. I'm going to be stuck in that for an eternity just to capture 1R. If my stop is super tight, let's say just the first low that I could possibly find, then it's it's so close to the point where if my trade idea is wrong and price just happens to blip down like this, um, I'm not going to be fast enough to cut it, right? I won't even have any some early signs to show that my idea is wrong, right? Because if this is the stop, is there any, like, how could I possibly know that my idea is wrong early? There's just no way, right? There's no way. So the margin of error on a super tight stop it's super low. Like it's so hard to manage a trade. Like the tighter the stop is, the harder the trade becomes to manage. The wider the stop is, the easier the trade becomes to manage, but the less P&L we can actually squeeze out of the trade, and we have to sacrifice some risk reward, and we also have to sacrifice time for that as well. But yeah, 5 to 15 candles away, or just the second swing point that you could possibly find. And then the first swing point that acts as my FTA, and if I get a candle close through that, I'm whoop-de-doo, my trade is invalidated, and I market close out of it. Okay, sweet. So that is question 1 done. Maybe I'll just put a little green tick next to it. There we go. Because there's a lot of questions today. All right, question 2. Can you look at my software/product and give me feedback on it? So for context, on my X, I get a lot of messages of people who are building tools, building trading tools or trading platforms, or custom vibe-coded trading journals, vibe-coded screeners, etc. Highly appreciate that you would reach out to me and request feedback on it. At the moment, I just simply can't. I simply can't, because in order for me to explain, in order for me to like properly understand what your software or what your product is, I'm gonna have to put in quite a bit of time to like play around with it, get a feel for it, see what's good, see what's bad, and then give you like some proper feedback on it. I don't like the whole idea of just giving like a quick skim through something and giving like really basic feedback. I'm not a fan of that. If I give feedback on something, I give like really proper, really in-depth feedback, and I just simply don't have the time capacity to look at your software or the products that you guys build. So at the moment, I can't do that. But if you guys send me in like a trade screenshot or like a trade idea or a strategy idea, that is a lot easier for me to give feedback on, because it won't require that much time for me to give feedback. If you send me an entire trading journal with like 300 trades, and you say something like, oh yeah, please do like an in-depth feedback of my 300 trade journal, I probably won't be able to do that. Right? But like for something small, like quick feedback, like on a trade screenshot or like a trade idea, something like that, more than happy to. There we go. All right, question 3. What are 2 skills worth developing as one learns trading? Okay, so I actually have 2 answers for this. So we're talking about standard skills, and we also have meta skills. So a standard skill is just how you do a particular thing, like what actions do you do, or like how good are you at doing like something very specific. But a meta skill is a type of skill such that if you improve at this skill, it improves all other skills which lie underneath that. So, okay, examples. 2 standard skills that you could improve at, which will probably help your trading. The first one is learning anything to do with AI, and the second one is marketing, and I'll explain both. So AI is definitely going to be a big one to learn as time passes, because the capabilities of AI are improving exponentially. Like if you compare what AI is capable of doing right now, and you compare that to like 1 year ago and 2 years ago, it's insane. Oh, and also there's a huge gap between what the average person thinks AI is capable of and what AI is actually capable of doing like right now, right? So there's a huge gap, huge gap, and that's just like a skill deficiency and also just like an awareness deficiency. So like most people, they say, okay, I think AI is capable of like vibe coding an app or vibe coding like a website. And I think that's, or like vibe coding like some kind of tool, and maybe doing like some short form like TikTok, Instagram reels type stuff. And like that's like the peak of what the average person thinks AI is capable of. But actually, like currently right now, it's a lot like it's a lot further than that, right? So that's a big one. And the main reason, like the main things that AI can help you with at the moment in trading, there's two. So the first one is speeding up your research slash data review process. So like when we're trying to improve a trade, like an existing trading strategy, the process of how we would improve that is first we come up with an idea, then we collect data on that idea, then we review the data. That was meant to be an R. There we go. Then we review the data, and then we iterate, or we don't iterate based on how the review looked like, as in we make an improvement or we don't make an improvement, or we make a change or we don't make a change to how we execute, and then we restart. So it's this constant cycle of tinkering with your strategy in hopes that the more times that you go, the more times that you iterate, the more P&L, or the stronger your strategy gets over time. That's the idea, right? So the more times that we go through this loop, the stronger our strategy gets, right? If we go through this loop only one time per month, then over a course of a year, we've only made 12 iterations. But if we can go through this loop, let's say 100 times per year, we're going to make more iterations, and therefore we'll have a more optimized strategy, or a more optimized process. So AI can help speed up this loop-de-loop process. That's one way. So it can generate ideas for you. It can research the ideas and collect data on them for you. It can review for you. But the iterate, I don't know if it can do this for you. Maybe. I wouldn't put that into the hands of AI. Me personally, I wouldn't be doing that. But yeah, it can help speed up with any of these processes. The second thing is it can, like at the moment, it can actually help you with execution. So like for sure, you can get an AI agent to execute trades on your behalf. For sure. Like for sure. Right now, like how good AI is like right now, that absolutely is a possibility. Like basic things like arbitrage or things like that. I wouldn't put it, I wouldn't give it like discretionary type of strategies just yet. But for doing little things like arbitrage and stuff like that, I think for sure AI is definitely there. So that's the first one. The second one is marketing. So trading is well, crypto slash trading is a really interesting industry where it coincides very nicely with the skill of marketing. What I mean by this is right now there is an overwhelmingly large number of players who have the skill of marketing, but they don't have the skill of trading, but they're in the trading industry, right? But they still make lots of money. So I'm just going to say that again for how absurd this is. There are people who are not profitable as traders, but just because they know how to market and tell people that they exist, they can make obscenely large amounts of money from the game despite not actually having the trading skill and still being in the trading industry. This is like being in the fishing industry, but not actually being able to catch a fish. But just because you're good at social media and you just talk about fishing, you make obscene amounts of money from fishing. It's silly. Okay, another example. You talk about combat sport. You have no skill in combat sport whatsoever, but you can still make obscene amounts of money from the combat sport industry, right? So it's absurd, right? It's absurd. So if you pair this with your trading, it will for sure make life easier. And not in the sense that, oh, you have to go open up a paid group or you have to launch some kind of service. Like, no, not even. Not even. There are a whole bunch of people in the crypto industry or just the trading industry in general who they just talk about trading a lot. Some of their posts went viral. They cracked the code for like how to get viral more consistently. They build some kind of brand. They get referral deals. They get affiliate deals, and they get paid really large amounts of money just for simply promoting exchanges or promoting platforms or promoting tools. And that is a totally viable option, right? I know a bunch of people who make well over $10,000 a month just purely from affiliates, right? Purely from affiliates. So, oh, that's one thing. And then the second thing is, um, there is the option where, like, if you can strike a deal with an exchange, some exchanges do actually offer you slightly cheaper fees if you help them with promotion. So, like, I'm not going to name names, for obvious reasons, but for example, if the standard fees on a market order are 6 basis points, so 0.06%, if you happen to be a VIP or placed into the VIP program where you are promoting the ref link and all that, and you're trying to bring people onto the exchange, they will put you onto something like 0.05 or even 0.04, depending on how much volume you can bring them. So they will literally reduce your fees if you can help them with help them with promotion. So, like, even if you're not like a guru or something like that, it can still help you with your trading by giving you lower fees, and lower fees by default, assuming like nothing else changes, makes your P&L go up. So those are the two like standard things, which I think are definitely worth investing in right now. Oh, and also for marketing, just real quick, I'll make this final point before I move on to meta skills. So in the past, if you wanted to advertise something, anything, you had to pay money to a TV station, or you had to pay money to a newspaper station so that you can get your ad featured, or you would have to pay some company so that your advertisement would go into people's like literal mailboxes, like a piece of paper, like a flyer or something. Or you'd have to pay someone to like hand out flyers, right? Like you had to literally pay people to let others know that you exist. But right now, the cost of doing this is zero. So it doesn't take there is no cost to letting people know that you exist. So you can promote something for free, right? For free. And if the conversion rate, so what is the percent likelihood that someone that you tell people, someone that you have told that you exist will make some kind of purchase, or that you can make some kind of money from them? If the likelihood that that you can make money from them is greater than zero, but less than 100, and this converts to actual cash, so for $0, there's a percent likelihood that I can make some money. Like that is ridiculous. That means that the EV per trade, per social media post, is technically infinite. Like, it's technically infinite if you really think about it, if we're just talking in units of money. But when we really boil it down, the EV per trade should not be measured in units of not per trade, per social media post. The EV per social media post should not be measured in dollars, but it should be measured in time. So how much time do we need to invest for a certain percentage of people to convert and make money from them, right? But still, the point is that it's mind-boggling. We can advertise for free to a very large number of people globally, internationally, right? Before you could only do it locally. Now you can do it internationally. So it's insane, right? This is highly underrated, okay? And to like prove the point, there's a bunch of people who have no technical skill whatsoever, and just simply because they have this skill, they can make a bunch of money. If you do have technical skill and you pair it with this, you'll make even more money, right? So this is worth learning. Okay, now let's talk about meta skills. So the first one is how you increase your own rate of learning, right? So the better that you get at increasing the speed of how you learn, the better. Because if you learn if you're developing a standard skill, whether it's learning AI or learning marketing, learning guitar, whatever, for every 1 unit of time that you spend, you get slightly better at whatever that skill is. But if you get better at your rate of learning, let's say you're investing your time and energy into improving at rate of learning. For every time that you level up in your rate of learning, the size of these steps of how skilled you get at the standard skills basically moves up, right? So the speed of how you move up this ladder in your standard skills, it it basically improves not linearly, but exponentially. So like if all you do with 100% of your time is only spend that time on just marketing, you will improve like this. But if you spend some of that time on your rate of learning and then the other part of your time on marketing, what will happen is your rate of learning will, since each of these steps gets larger over time, you get a non-linear curve. So you get an exponential type of curve of how good you can get at that particular thing. So increasing your rate of learning is 100% worth it because the ROI of how this impacts everything else is huge. So this one is really big. And then the second one would be your metacognitive introspective awareness. I know this is a really fancy word, but basically what this means is how aware are you of your own thoughts, your own thinking, and your own belief systems. So this isn't like, okay, let me explain. So let's say thinking you're thinking about an apple, right? When you picture this apple in your mind, and you see the apple, you're like, oh yeah, I see an apple. That's like level one. That's like level one type thinking. Level two type thinking is recognizing that the apple is just a thought. So whatever the contents of this thing is, it's just thought. And you're just like, oh, okay, a thought is appearing. Oh, this other thing, whatever the contents of it are, this is just a belief, right? So the reason why this one is so important is because when you can zoom out and when you can negate the contents of whatever is inside the thought or the belief or like your like I don't like this word, but I'm just going to use it anyway. Your programming or your conditioning, when you can zoom out and when you can look at it objectively, it's a lot easier to kind of look at your thought process as a whole and start tinkering with it and adjusting it. Because your beliefs are like clay. You can change them and mold them to whatever you want. And the same with your thoughts to some extent, right? So you can't fully control your thinking, but you can influence it to some extent based on the belief systems that you have. So this is really effective because, the reason why I think this is so important is because the more clearly that you can, or the better that you are at zooming out and just looking at your thoughts or your beliefs, your emotions, feelings, etc., objectively, the less bias you can have when doing anything, and the less biased you are, the more objective you're thinking about some kind of process, the more like fluid and open you are to changing and to adjusting and to iterating to whatever is actually optimal. So like you might have a certain belief like, oh, I think that this is the best way to do something because of reason X, Y, and Z, right? But it's a skill to look at that belief and say, this is a temporary thing and I could be wrong about this. And to look at your own beliefs, especially the ones that you hold so firmly, and to say, what if I'm wrong? Or what if I replace this with something else? Would my output or would my results be better? And doing this can be hard because we often kind of like stick these labels onto ourselves, like, oh, I'm this type of person. Oh, I get this is the kind of results that someone like me gets. Like, okay, I'm not going to drag on with this for too long, but the point is that the more that you can zoom out and look at your thoughts, your beliefs, your emotions objectively, rather than subjectively and be so caught up in them, the easier it will be to learn faster, to look at data more realistically, and to see things more clearly. And the more clearly that you can see, the easier it will be to go through this loop and actually get better results. Okay. Hopefully that answers question 3. All right, question 4. Can you give me more info on your beta test product and your paid product, please? When will it be ready? Okay, let me move over to this. All right, so for context, I have still a bunch of stuff to do, to create free content. But after all of these things are done, and I'll get into them like at the end of the video, I want to create a beta test mentorship. So this is going to be a 30-day bootcamp for people who want to seriously level up their training, and it will be like it will be very intense. You're going to be getting very regular one-on-one calls with me. I'm going to be regularly breathing down your neck, telling you what to do, giving you homework tasks, reviewing the trades that you take, correcting them, reviewing your journal, giving you reviews on your journal on a very regular basis, one-on-one calls, group calls, etc. Like the whole bunch, what you would expect in a boot camp slash mentorship. But anyway, this mentorship is going to be completely free, and it's going to last for 30 days. And the goal of this 30 days is for me to collect as much data and also as much feedback from the students as possible before I go and switch it and launch for paid. And I'm going to use that data and use that feedback to do more good stuff and also to do less bad stuff. So just anything like, how can I improve my service just a little bit more? Is there anything in the product that I need to remove which will make the quality better? Like little things like that. Oh, and also I really want to use the beta test, this free beta test, to collect a bunch of testimonials and reviews to make that transition from free to paid a lot smoother. So my estimate is that maybe 1 to 2 months this beta test will be ready. And then after the beta test is done, I'm going to give like myself 1 week to go and actually use the data to clean up the product. And then after the cleanup phase, then I will go and launch the actual paid product. So this is going to be, I guess, maybe 2 months from now, maybe 3 months from now. I would say 2 to 3 months. Yeah. Exactly like all the specifics of what's going to be inside, I'm not 100% sure yet because I'm just like not at that stage yet. But there will be one-on-one calls. There will be group calls. There will be accountability, journal reviews, trade reviews, live trades from me. Like me giving my regular takes on the market currently, like what do I think about the current market conditions? What do I think the market conditions will evolve into over the next N number of days or weeks or whatever, things like that. It's just going to be a very intense one-on-one and also a one-to-many like hardcore learning environment. All right, sweet. That's number 4. Question number 5. Do you consider ATH all-time high? This is what this stands for, all-time high. Do you consider all-time high levels when trading reversals? Well, funny that you should ask, because on page 54 of my Mean Reversion Trading Guide, I actually cover this. So all-time highs, they are pretty big levels. I write here, they are huge major levels on a chart, and pretty much every single trader and investor is going to be paying attention to all-time highs and all-time lows because it's a pretty major level. Because beyond the all-time high, it's new territory, it's price discovery. So there is basically no valid ideal place to take profit. Right? It basically becomes a free-for-all for where is an ideal place to take profit. And because there's no like clear level for where to take profit, because there simply are no levels, it's just blank space above the all-time high, all of the take profit orders, they basically become diluted over a diluted up as price goes, right? Instead of, if there is a noticeable resistance level, then all the take profit orders are just going to be concentrated at that specific place. But since they're diluted, what that means is, like, since the orders are going to be more spread out, since there are no levels like on the way, like beyond the high, it means that the amount of pressure required from market buy orders to push the price up is going to be less, right? So that there's less pressure required to actually shove the price and make it go higher. So for that reason, for all-time highs and also all-time lows, I actually don't like trading reversals at those levels. I much prefer to just go for the breakout. Not always, I'm not saying that I always trade a breakout at every single all-time high or all-time low break. I'm not saying that. I'm not blindly going into every single one, but rather if price is approaching an all-time high or an all-time low, I would much rather just trade the breakout rather than the reversal, because like the price action at these levels most of the time is like really, really, really violent. So yeah, I prefer it for breakouts, not reversals. All right. But yeah, if you want more information, just go to page 54 of the mean reversion guide. All right, next question. How to review a trading journal. Okay, this is a really good question. I love this question. So this is like a really open-ended question, and there's like a bajillion different ways to do it, depending on what your actual goal is when you are reviewing this journal. So it really depends on what are you actually trying to achieve when you are reviewing your journal. So what I've done is I've included a link here to a template. Oh, that's right. You guys can't click on this. Okay, what I'll do is I'll include this link in the description of the video. Like I only just realized now. Yeah, I'll include the link in the description of the video, or I'll throw it into the comments. I'll put it somewhere in there for you guys to access. But this is basically what you'll get. So this is a basic trading journal review template. And here in the title, it says you're going to have to go to File and make a copy so that you can actually use it. So you're going to have to click File, make a copy. There we go. That way you can actually interact with it. Okay. So I'm going to explain everything here. So we have two columns. We have good trades and we have bad trades. What we want to do is we want to go into our trading journal and put all of our good trades into this column and all of our bad trades into the other column, into the red column. So what makes a good trade? A good trade is a trade where you followed all the rules perfectly, and a bad trade is a trade where you broke your trading rules, right? Another thing that could make a good trade is a winning trade where price went far beyond the target. So for example, where was it? Here we go. So this is a 1R. I'll use a smaller brush. So this is a 1R trade, and price went far beyond that 1R target, and it went way beyond it, right? That makes it a good trade. But for the bad trade, it would be if the trade won, so it hit the TP and then price just reversed and it went straight back to the entry or even to the stop loss. That would be a bad trade. Now, what you might be thinking is, wait, hold on, wouldn't a good trade be where you exit perfectly and price turned around and hit the stop loss, because that means that you timed the exit perfectly? And if price went way beyond your target, doesn't that make it a bad trade because you missed out on all of this excess P&L? So I know exactly what you mean, because this is very frustrating to happen, but when you nail the exit perfectly, it's very satisfying. But in reality, it's actually quite counterintuitive. You have a really good exit when price moves far beyond your TP. The reason why this is a good trade is because you have such a high margin of error on the exit. It basically means that you could have exited slightly earlier or slightly later. It doesn't matter. The idea itself was so good to the point where you could completely botch the exit and still win the trade. But with this one, where price reverts after your TP is hit back to the entry or to the stop loss, like let's say this happened, right? If you exit like 5 minutes later or 10 minutes later, your trade wouldn't be a winning trade. It would be a losing trade. That means some luck was involved with you actually securing a profit. The less luck that needs to be involved in order for you to win your trade, the better of a trade it is. I'm not saying that the exit itself was perfect. I'm not talking about like how much P&L you could have captured or squeezed out of the trade, or how much you could have maybe missed out on. I'm not talking about that. I'm talking specifically about how much margin of error do you have with this entry. That's That's basically what I'm trying to say. So when your winners go far beyond the TP, you've nailed the entry. If price instantly reverts after your TP, it's not ideal because some luck had to be involved in there, right? So we're plotting the opposites, right? High margin of error, it's put here. Low margin of error, it's put there. And then the same with the losing trades. So if your losing trade, let's say you entered a trade, it hit the stop loss, and then after it hit the stop loss, it keeps going much further down. This is a good trade. Why? Because it means that your stop loss served its function correctly and prevented further losses from occurring. It means that you exit the trade because your idea was successfully invalidated, because the complete opposite thing to your idea actually occurred. So if you enter a trade, price guns to the stop loss, and then completely collapses far below that, I get how it can feel emotionally. Like emotionally, it might feel like, wow, I was very, very wrong on that idea, and it can sting a little bit. But logically and rationally, it means that you did the right thing. Like your stop loss served its function correctly. So well done. And the opposite of that is your stop gets hit and then price turns around, goes back to the entry, or even far beyond that. So this would be something like, imagine you have your stop loss at the opening of this candle, right? So it's like, okay, you get stopped out and then price explodes. So your idea was perfect in terms of the directionality, but you still lost the trade. So you fumbled somehow. Therefore, if price reverts after your stop loss is hit, goes back to your entry or even beyond it, like let's say to the target, you'd put that as a bad trade, right? So put all your good trades in this column, put all your bad trades in that column. You don't have to adhere to these rules for how to define a good trade or how to define a bad trade, but this is at least how I would do it. To keep things simple, like if this is the first time that you've ever reviewed your journal, like ever, first time, I would just stick to this. I would just stick to putting all the trades where I followed the rules perfectly and put all the trades screenshots where I broke the rules. Okay. After you've put all your screenshots into this template, what do you do after that? So step one is we want to look through all of the good trades and we want to try and find similarities between those good trades. So what you can do is you can select all of your screenshot links like so. Then you can right click and then there should be a button which says, oh, I don't have links in here at the moment. But if you select all your trade screenshot links, you can right click and say open all links or something like that. After you click open all links, you can just go through all of the screenshots one at a time and just try to find anything that is similar between all of the trades. After that, do the exact same thing for all of the bad trades. So open all of them up, go through them one by one and try to find everything that is similar in each of the bad trades. It can be anything. It doesn't matter like how perfect you are with this. You're just trying to find anything that might, maybe, question mark, maybe, resembles itself. So for example, it's really interesting how all of my bad trades just so happen to be the first trade of the day. Or it's interesting how most of these are the last trade of the day. Or it's interesting how all of these I've taken after 10 p.m., like 30 minutes before my bedtime, and then I have to somehow rush the exit or the management of the trade, and I somehow fumbled. Or like something like that, right? You're trying to find some similarities that have occurred in these bad trades. And then finally, step 3 is you want to try to play the game of spot the difference between the good trades and the bad trades. So what is so different about the good ones and the bad ones? So in order of priority, this is what I would recommend. Number 1, first find your blatant mistakes where you are deviating from your rules. So what are the similarities? What are the reasons for you breaking your rules, and which rules specifically are being broken? Are you entering too early? Like let's say if your rule is I'm going to enter this trade after 2 candle closes through a level, and you're entering it after 1 candle close or before it even closes through the level, you broke your rules, right? This isn't about losing trades. Just because you lost a trade doesn't mean it's bad. It's, did you actually adhere to the rules? So you could have won a trade, but if the rules were broken, the rules were broken, right? This has to be fixed first, because if you can't follow rules, it doesn't matter how good the rules are, right? You could have a perfect set of rules. You could tinker them, you could optimize them, you could find all of these fantastic differences between your good and bad trades, tweak your strategy, improve it. But if you can't follow the rules, like all of your optimization just goes out the window because you're not adhering to the rules. So the first thing that you have to fix is the adherence or the consistency. So number one, find all of your blatant mistakes where you are actually deviating from your rules. This has to be fixed first. If this is fixed, like after you have fixed this, then you can move on to step 2 and 3. If you have not fixed this, ignore step 2 and 3. These two steps do not matter until this is fixed, okay? Okay, now let's pretend that we fixed the first problem, which is adhering to your rules. The next thing that we want to think about is how can we take fewer bad trades? So this is not breaking the rules, but rather how can we take fewer trades where price is reverting after the target is hit and going back to the entry, or how can we take fewer trades where price reverts straight away after the stop is hit? So we want to think about how can we reduce this. The reason why this is number 2 is because if you're taking less bad trades, you're going to get a higher win rate by using less time and less of your effort, right? So you are literally clicking the button less, right? You get your time back and you get your mental energy back. So you can actually use your time and your mental energy to go and improve your edge further rather than just executing lower quality trades, right? So this is the first, this is step number 2. How can we take fewer bad trades? And then finally, the last step that you want to take is how can I take more good trades? So when you're taking more good trades, yes, that's going to increase your win rate, but there's an actual cost to this. So it's going to take you more time and more effort, because if you want to take more good trades, you actually have to click the button more. You have to do stuff more to get more good trades. So this comes last because there's an actual cost with this. When you do fewer bad trades, you actually get your time back, right? When you do more good trades, you have to use your time. The issue that a lot of traders have, this is the order that they do it in. They first want to do step 3, then they want to do step 2, and then they want to do step 1. So they have it completely backwards. I would recommend first fix your errors. Just get rid of all of your errors first, so you're perfectly following your rules. After all of your rules are perfectly being followed, just take fewer bad trades, and however many good trades you're taking, you can keep that the same. Doesn't matter. Just take fewer bad trades. After you've dropped this number down to as low as you possibly can, then you finally think about how can I take more good trades. Okay? So first, adherence. Second, do less bad stuff. Then finally, do more good stuff. And yeah, I will include the link to this template in the description. All right, let's keep going. Where was I? There we go. Number 6 is done. Number 7. How do you look at volume not being met on Bybit, but it is being met on Binance? So let's say Bybit is doing $25,000 per 1 minute on average, and Binance is doing 140K. So for context, I don't like to trade coins which are doing less than 100K USD of volume per 1 minute on the Binance exchange, right? So the question here is, okay, well, what if it's only doing 25K, but not on Binance, but on Bybit? Then what? So I like to use Binance as a proxy because most exchanges, how liquid their books are going to, like a lot of the time, it's just going to be linked or correlated to how liquid the Binance book is. Because a lot of the, like when a new exchange pops up and then once they onboard a market maker to do all of their market making, if it's a third party market maker, a lot of the time they will be hedging on Binance because Binance is like the most liquid exchange. A lot of the time, that's where they'll be doing it. Alternatively, and this is, I don't know exactly which exchange does this, but I have heard rumors that a lot of new exchanges that are being popped up, they just literally onboard the Binance team to handle everything with their trading engine. I'm not going to name names because it's just rumors, just from shadowy conversations that I've had. So I can't confirm that, but it makes sense. So for that reason, I think that most of the time when a coin is doing 100K per 1 minute on Binance, it should be liquid enough on other exchanges to trade. So that's like point number one. But point number two is this is not always the case. So what I like to do is like if I found a coin that I'm interested in trading, I will take a look at the book. And the question that I need to ask is, if I was to execute a trade on this coin for this much position size, whatever that size is, let's just say that is X. If I was to execute a market order for this size right now, would I be slipped more than 0.05R? If yes, then I probably should not take that trade, or I should reduce the size, like how much size I'm entering into this specific coin. But if sure, I can enter the trade and I probably will not be slipped more than this amount, then I'm fine to enter on whatever that exchange is, whether it's Bybit, BitUnix, Blowfin, whatever. The main point, that like the main most important thing is if I was to enter a trade for this position size, how bad is my slippage going to be? And if it's going to exceed whatever this number is, then it's going to be a bit of a problem. So for context, let's say that the size of the move that I'm trying to catch is 1%, right? Actually, no, because I don't use market orders for 1% moves. Actually, no, even for 1% moves, let's just play along. Let's say I'm trying to catch a 1% move, right? And let's say that I want to execute a trade with a $50,000 position. But if I look at the order book now, and I see that if I was to market buy $50,000 worth of whatever this coin is, and it would, just my order alone would push the price 0.5%, that would be a problem. That would be a problem. Because this is just slippage, right? Oh, sorry, even if I'm not entering the trade, but this would apply to the exit because I don't use limit orders for 1% moves. I would only use it for 3% moves or higher. But let's say I'm going for a 1% move and my stop loss is also 1%. So I'm just going for a 1R trade. If my trade idea is wrong, right? And then let's say the thickness of the book maintains itself throughout the trade, roughly, like how thick the order book is doesn't drastically change while I'm in the trade. If my stop gets triggered and then I get slipped this amount, right, 0.05, and then I have to pay the 0.06 fee, and then I also paid the 0.02 limit order fee, so that's 0.05, 0.06 for the taker fee, and then 0.02 because that's how much I had to pay for the entry. That is 13 basis points that I've lost. So that is 0.013% that I've lost. This divided by 1% is just 0.13. So this is how much units of R I have lost purely to fees. Purely to fees, right? That means the real risk reward of this trade is actually 1R over 1.13. And let's do the math on that. It's something like 0.80 something. 1 divided by 1.13 is actually the real risk reward of that 1R trade is actually 0.88, right? So now it's like, just to break even on this trade, I'm going to need a 52 or maybe 53-ish, maybe 54. I think it's 53 Oh no, there's 0.02. It might be like 53.5% win rate just to break even on that. This is just to break even. That means that if I can maintain a 56% win rate, the edge that I have is just going to be this small little smidgen of a 2.5%, which is, it's brutal. It's brutal. That's why, like, at most, I'm not really a fan of being slipped more than whatever 0.05 R is. I hope that answers the question, and I hope I didn't go too nerdy on that one. But yeah, long story short, if it's at least 100K on Binance, you should be fine trading 50K size. That's point number one. And then point number two, yeah, just double check the order book and just check how badly are you actually going to get slipped in units of R. Check how much you're going to get slipped in units of R. And if that number is going to be a big number, then avoid it or just drop your position size. Okay, next question. Actually, this isn't really a question. This is more of a statement. I'm serious. Your video was so good. So this is talking about my previous video. Okay, so in my previous video, I was talking about the theory of constraints. If you're unfamiliar what this is, I'll just give an analogy. Oh, there we go. So let's say this is a water pipe and the water pipe has 4 parts to it. And let's say the goal is to get as much water flowing through this pipeline as possible. If we had to expand part number 1, part 3, or part 4, even if we were to expand it, we wouldn't actually get more water on the other side. It would be the same. And the reason for that is because the constraint is pipe number 2. Because as the water flows through this pipe, it's going to be limited by what is the smallest pipe? What is the limiting factor to this system? What is the limiting thing, the constraint to this pipeline? Therefore, the only way that we can get more water through the pipeline is to expand pipe number 2. And this is relevant to not just for pipelines and waters, but also if you are in a factory and there are multiple parts to your factory system or your conveyor belt, you have to fix whatever the weakest link is if you want to make more products for your factory. In a business, this is the same thing. You have to find what is the limiting factor to your business, fix it in order to increase how much output you have. In trading, it's the exact same thing. What is the thing that is limiting your trading system? Identify whatever that is and expand it and fix the problem. If you're using your time on anything which is not your biggest problem, you are wasting your time. Anyway, this person said, gave me like a lot of credit for explaining that, but I just wanted to redirect this person to Nick Saraev. This is where I got the concept from. I actually got the concept from Atomic Habits, and I also got the concept, it was like reiterated again in the book Essentialism. I'm just going to write these books out. Atomic Habits, Essentialism. There we go. There we go. 2 great books. This is where I first discovered about the theory of constraints. But this guy, Nick, he explained it so elegantly and so perfectly in this video. And that's where I got the pipeline example from. So yeah, I'm gonna share the link to his video in my description, because yeah, this was so elegantly explained, and I basically copycatted his explanation for the theory of constraints. So credit can't go to me, it has to go to Nick. All right. Next question. So with testing data, there are so many influencing factors, call it noise. How do you make your decisions when you are unclear about the noise factors? Basically, how do you defer from correlation to causality for bigger picture understanding? Or doesn't it matter because the only thing that matters is, did it affect the expected value, positive or negative? Okay, so I don't like fully 100% understand the question, but I'm gonna try regurgitate back what I think this question means, which is, after you test an idea, how do you know how good this idea actually is after the results come through? Because it could have just been like, it could just be showing you good results from pure luck, or it could genuinely have some kind of edge there. I think this is what this question is asking me, but I'm not 100% sure, but I'm just going to roll with that. To the person who asked me this, if that's not what you asked, please just DM me again and clarify. But anyway, the answer to this is a validation test. So, okay, let me explain. Let's pretend that we come up with a strategy, which is like, let me use the text tool. If price closes, it is under the 97 moving average, and then it closes above it, get long, and hold the position for 30 candles, right? Let's just pretend this is our strategy, right? And then we go and look at the equity curve of this strategy. So this is the bankroll, and this is the trade number. And the bankroll looks something like this. It looks absolutely fantastic. An immediate mistake would be assuming that, oh my god, there must be something magical with this 97 moving average with where the close is after 30 candles. This combination is legendary and magical. It must work by default. So the thing is that it could have just been pure luck. It doesn't, just because we have a nice looking equity curve does not mean that we actually have edge, that just because there's something magical going on with these moving averages, with this specific exit. It could have just been luck. So an example, to prove that it's not luck, well, we can't like 100% ever prove it, but we can do something that's called a validation test. And the more validation tests your strategy passes, the more likely it is to actually have an edge, rather than for it to be pure blatant luck. I'm not gonna go through all, like, a whole bunch of validation test examples, but I'm just gonna give you one. And the first, the one that I'm gonna give you is the neighboring parameter test. So the neighboring parameter test is, if we were to use a similar strategy to this, will it give us similar results? If the answer to that question is yes, then it passes the validation test. If the answer to that question is no, then it's very likely that the strategy is just giving pure luck results. Okay, so example. Let's say we test not the 97, but we also test the 96. How does the P&L look like? The P&L might look something like this. Huh, interesting. We test the, let's say, the 70. What about the 70? Does the 70 give us good results? And the 70 might look something like this. We're like, okay, interesting. Instead of going down, let's go up. Let's test the 120 moving average. And then we get results which might look a little bit worse, but it's still looking decent. If we have something like this, then we're getting closer to, okay, there might actually be something here. So we're going to test it with not just the entry, but we also want to test the exit. So it's like, okay, sure, 97 moving average, but what about if we exit slightly earlier after 25 candles? How does the P&L look like, right? So if we get something that looks like, let's say we test a whole bunch of different examples, and the equity curve of almost all of them looks something like this. Sorry, excuse me. Equity curve of all of them looks something like this. That means that this equity curve is just an outlier. This is not the average result of this particular idea. What a lot of traders get wrong is when they think about edges or trading strategies is they obsess about the very specific parameters that they are using to express their execution. But it's actually not about the parameters, right? It's about what is the fundamental premise of the idea. What is like the average results of the average idea? Like if we were to plot like 100 similar strategies to this, does the average strategy, if we were to tinker with it a little bit, make money? If the answer to that question is yes, then we've nailed something. You don't have to visualize this in with an equity curve. An alternative that you could do is do a bar graph. So we've got total P&L here, and then here we've got the parameter. Okay, so let me explain. So on the y-axis, we have the total results. Let's say this strategy after 100 trades, or let's say after 1 year, it made 100% return. So for a 97, if we use the 97 moving average, it would be at 100, right? Then the 96 moving average, let's say this one is at 10. And then the 98 moving average, this one is at like 12, right? So we could do it in the form of a bar graph with all the parameters for the entry. And then from there, we can look at the bar graph and we can spot what are the outliers. So if we have something like, let me just draw this out a little bit. Whoop, what's happening? Okay. I'm just going to do a little bit there. Okay. And then if we were to plot a moving average through all of that, it would look something like this. Okay. So if we were to just say, okay, I want to just purely optimize for which parameters give me the absolute best results. What's going to happen? Well, we're just going to pick this one, whatever this parameter is. But the issue is it's not that this 100 or 97 moving average just happens to be magical. No, this is likely an outlier because the neighboring parameters don't actually do that well. If we want to optimize for what are the best parameters to use for the strategy, we want to pick the one where the neighbors are the top performing. So we want to pick for the cluster, for the best cluster of parameters, not the best isolated parameter. So here we have a cluster of good parameters, and here we can say, okay, if we wanted to optimize this strategy for the entry, just the entry, whatever this one is likely going to be the best one because there is going to be some margin of error here. So it means that, okay, if we used a slightly smaller moving average or even a slightly bigger moving average, the performance would still be pretty decent. Therefore, this one is probably the nicest one to use. But okay, that you would do this process for optimizing the entry and also for optimizing the exit as well. But this is just one example of a validation test. But the idea is that the more validation tests that you can pass, the more likely it is that you actually have an edge versus you were completely pure lucky. So on one extreme, it would be, oh, my strategy passed a back test. Like my strategy has a good looking equity curve on a back test. Congratulations, you passed the first validation test. That's one, right? That's literally one, right? But the more, so it could have maybe just been lucky, right? But the more of these validation tests that it can pass, the more likely it is that you have an edge versus it was pure luck, right? I'll make one other extreme example of something that passes like a massive validation test, and I'll actually circle back to one of the previous questions. Marketing. So let's say we have here a guy called Bob. Bob loses money as a trader. He loses 5% per month as a trader. He is a non-profitable trader, right? Then he goes on social media and he talks about trading. And then Bob somehow from social media, after talking about trading a whole bunch, he now starts making $5,000 a month, despite being a losing trader and not knowing anything about what he's talking about. After one of these instances, after Bob doing this, you might look at Bob and say, okay, well, Bob might just be lucky with whatever he's doing. He's just a silly guru on social media. He got purely lucky. It just is what it is. But then Timmy comes along, and Timmy is another trader who has some other style or method on, I don't know, equities. He talks about equities, and he's a losing trader as well. And he also makes $5,000 a month. And then there is another guy. This guy also is a losing trader. He loses 7% a month. But this guy manages to make $10,000 a month, right? Just because he has the skill of marketing. So it's like, okay, after one guy has the skill of marketing and he's making $5,000 a month from social media, you might say, okay, this guy's he's just lucky. Second guy, he's just lucky. Third guy, he's just lucky. Fourth guy, maybe they're all lucky. More than 100 or like 500 of these gurus exist who have no idea about anything with trading, but just because they have the skill of marketing, they're doing 4 to 5, even 6 figures per month in profit. So the logical conclusion that I get from this observation is that, okay, there must be some kind of edge with marketing, because like what the barrier of entry into this game is so absurdly low, to the point where like more than 100 of these guys can exist and continue to make upwards of this amount of money on a monthly basis. The fact that this is true and observable currently makes me believe that there is an edge there, and hence why I'm pursuing this goal, because I think that social media is heavily mispriced at the moment. But yeah, to answer your question, I hope that answered the question. You will need to run a validation test and basically stress test your strategy with different angles or different data sets to see, like, does it actually break under the stress, or does it break under additional pressure? The harder your strategy is to break, the more likely it is to have an edge. The easier it is to break, the more sensitive and more fragile the strategy is. Hope that answers the question. If it doesn't, remember, just send me a DM again about this, and I'll answer it. Okay, next question. This is more of a statement. So this person sent me this picture of the red card game, and they said, this made me happy. For those who don't know what this is just referring to the process of learning or improving at any domain of skill, whether it's trading or anything. So I wanted to include this here because I think this is really important, since a lot of traders misunderstand this process of improving, or this concept of improving. A lot of traders believe that they only improve once their P&L goes up, or once their bank account goes up, right? But this is not the case. Your P&L has a lag after you have an insight, right? So like, first you have to learn something new, right? You have to change your behavior. You have to stop doing something, and you have to start doing something else. And only after you start doing something else, some time passes, and then after some time passes, then you see the change in the result, right? So the result is a lagging indicator of learning. Learning occurs only after your behavior has changed, right? And the red card game is a really good analogy for this. So let me explain. So the red card game is a game where, let's pretend this is me, and I flash a red card. And then 3 seconds after I flash the red card, I slap you, and I hit you on the face, and you say, ouch, that hurt, right? So I do this once. And then again, I pull out a red card, I wait 3 seconds, and then I slap you again, and it hurts, you say ouch, and then so on and so forth, right? Let's say after 6 times of me slapping you, finally you decide, I think that Spicy is going to slap me, right? After this red card is shown. And on the 6th, so on the first time, you do nothing, right? You get slapped. On the second time, you do nothing, you get slapped. Third time, you do nothing. Fourth time, nothing. Fifth time, nothing. But on the sixth time, you decide that you want to move to the right. You want to try to dodge my slap. But you still end up getting slapped. So you still end up getting hit, right? So the incorrect logic here is, oh no, I haven't improved because the result is the same. I still got slapped. Actually, I got slapped faster because my face connected with Spicy's hand faster and actually hurt more. So I actually did the wrong thing. I didn't learn. I didn't improve. I suck, blah, blah, blah. Whiny, right? Complainy. This is a mistake because the fact that behavior has changed means that you have successfully learned. Because learning is once your behavior changes. Sure, your behavior changed and you didn't get your preferred outcome, but that doesn't matter. What matters is the behavior change, because this is the only thing that can actually influence a change in the outcome. Now that you've changed your behavior and you notice that if you move to the right, you actually get slapped at a faster speed, you now have this new insight that, if I do nothing, I get slapped. If I move to the right, I get slapped at a faster speed and it hurts more. Therefore, I'm going to try to move to the left now. And after you move to the left, maybe you still get slapped, but it hurts less and you almost dodged it. Like you were very, very close from dodging the red card. This also is a successful iteration, right? So, it is an iteration. Might not be a successful one, but actually no, you could count it as a successful one because you almost avoided the hand and it hurt less as the slap actually appeared, right? So the goal is basically iteration, because eventually you learn that, maybe after trying to dodge after 3 seconds, I'm going to now dodge. I'm going to move to the left, but I'm going to move to the left after 2 seconds instead of 3. I might actually avoid the slap. And finally, you have avoided the slap and you've got your preferred outcome. So the problem is that a lot of traders, they think that this is the point where learning has occurred. This is. But they're wrong. Learning has occurred here. This is where learning has occurred. This is where learning has occurred. And this is where learning has occurred. Learning is as soon as you change whatever it is that you're doing. Because as soon as you change whatever it is that you're doing, even if you don't get your preferred outcome, you get feedback, you get data, and you can use this data to make your next decision, like a more informed next iteration. So the goal over time, if you really think about it, is to collect these experience points and to increase your total number of iterations. Because as you increase your total number of iterations, like if this is iterations and then this is your level of skill, they're going to be correlated, right? Your skill is going to be correlated to the total number of times that you have iterated or changed something in your system based on the previous data that you have gotten. So if you're having a bad week, bad month, bad whatever period of time, based on your results, as much as it stings, you want to look past the results. So remember here, where was it? Here we go. You want to look past the emotion, look past the thoughts, and look at objectively and say, how many iterations did I actually make, right? How much did I actually learn? How much of my behavior change did I actually, like, how much did my behavior actually change? How much new data was I able to gather? How many new insights was I able to obtain, right? That is ultimately what matters, right? And this is why metacognitive introspective awareness is such a big deal, because when you have a losing week or a losing month, it can be very easy to get stuck in the thought and say, oh no, I suck, I learned nothing improved, blah, blah, blah. But it's like, no, actually, like, you could have got a lot of insights, and the results are just going to be, they're just going to come with a bit of a lag after the behavior change, right? So yeah, this one is a very important one. All right, let's move on. Top tick needs a lot of context. It could also just be a coincidence that we top tick then not due to a high limit order there. Shouldn't we always keep the vol and bookmap in consideration for this? Okay, so for context, if we have a resistance level, and then price approaches the resistance level, and then it tags it perfectly to the exact perfect tick, and then it reverses. So imagine that this resistance is like the highest point. So let's say it's $10.11, and then price hit exactly $10.11 and then started reversing. This would be a top tick. And if it hits the level perfectly, and then it starts trading in the opposite direction, so let's say it hits the level perfectly and then the next candle is a red candle, this would be a fantastic signal for a short in the opposite direction, because it shows that whatever limit orders were available at that resistance level, they were partially filled by the market orders that were executed into that level. Most of the time, people have their stop losses at these swing highs and swing lows, and most of the time when those stop losses are executed, the size of the aggregate, the total stop losses plus the size of the total market buys from people who are trying to enter a breakout trade, most of the time it will exceed the available liquidity, or how much is totally available in limit orders at this specific level. Most of the time it will exceed it. And that is why even if price was to reverse, most of the time price would at least trade through the level a little bit before reversing. Most of the time, this is how it looks like. On the reversals and on the breakouts, it would go. So the fact that price hits the level perfectly and then starts trading in the opposite direction, this is actually an anomaly. It's an outlier. It's an abnormal behavior. It's very abnormal for these limit orders to be partially filled by all the market buy orders from people trying to enter breakouts, and all the market buy orders from the short positions that were just recently stuffed out. It's very abnormal. So this could mean two things. One, it could mean that the size of the size of the limit orders that were present on that level were enormous, so big to the point where they absorbed all of those market buys. And that means that someone really badly wants to get short, so they get partially filled on their short, and then with whatever leftover is remaining, they will fill the remaining of their position with market sell orders, and they'll basically help contribute to pushing the price down. And any of the traders that were stuck from long up here, they end up puking their position and also contributing to pushing the price down. That is why short term, this can act as a really good reversal signal. So that's reason number one. Reason number two is there's just barely anyone who's willing to market buy. If there's barely anyone willing to market buy, but there's still a normal, reasonable amount of people who are willing to sell, just because of that imbalance, price just gradually drifts down. But the point is, in both cases, or even if both cases are simultaneously true, price a lot of the time ends up drifting down. So the question here is, this specific pattern needs a lot of context, because it could have just top ticked this level by coincidence. True, very true. Something that increases the quality of this top tick signal are two things. So, and they're somewhat correlated, but still. The first one is, what is the amount of time spent from this level? So if this is like a level that was formed 1 minute ago, and then it just so happened to be top ticked, it top ticked a level, so it returned to a price that it traded at 60 seconds ago, and then it starts trading in the opposite direction, it's not that significant, right? Whereas if this was a level that was formed like 17 days ago and it top ticked and now it's starting to trade in the opposite direction, that's a much bigger deal. So the first one is time spent away from the level. The second one is, what was the market orders, what was the volume that was executed on that top tick candle? So if this is the resistance and then price top ticked it like that, what was and then let's say that's the previous candle, let's say this is the next candle, and this candle is red, and it top ticked this level. What was the volume on this specific candle? And we're not looking at the exact dollar amount. We're looking at what was the volume relative to whatever the average volume is. So if the higher it is relative to the average volume, the better it is for the reversal. The lower it is relative to the average volume, the worse it is for the reversal. Because when we have huge volume that happen to be partially filled, then we can lean more in the direction of the idea of, okay, someone just really badly wanted to short this level, and now they've basically entered their short, or they have a huge position that they're trying to take profit on, and they got partially filled, right? In both instances, if someone is really massively trying to get short and then price starts moving away from their entry, most of the time they'll start slamming market sells, and they'll try and get an average entry price, right? So they try to get filled for as much as they can for the best price they can, and then once their idea starts getting validated, they'll add on the rest with market sells. That's for someone trying to enter a big short. For someone who's trying to close out of a huge long, they get partially filled on their take profit, then price starts drifting down. They're like, oh crap, I really want to get out of this long because my trade idea is already concluded. I just want to get out of this trade. Just get me out of this trade. So they got out for as much as they could on the level, and then they market sell out for as much as they possibly can as price starts drifting down. But the point is that in these huge volume scenarios where the top tick candle has huge volume, this gives us a lot more confidence. If the volume was tiny and it happened to top ticket, that's when it's like, it could have just been a coincidence. Not entirely sure. It could have just been a coincidence. But okay, let's keep going. But should we always keep the vol and bookmap in consideration for this? Bookmap as in the depth of market? Yes. Yeah. I would have that open. But the thing is that it's unlikely. Oh, I wrote this here. It's actually unlikely to witness a partial fill happen right in front of your eyes, right? Very unlikely that you open up a coin, you open up a random coin, and then a partial fill just so happens to appear on your chart. Quite unlikely. It's more likely that that you open up a chart and the partial fill has already happened, and you're just waiting for that next candle to form. That's like, at least from personal experience. Like, this is if you're like screening for a coin, and that's what happens. Therefore, I don't think the bookmap is going to be that super duper relevant for all the time. But I mean, sure, I think just having the depth of market just open for you to look at, just in general, is a good idea. Not necessary, but it's a good idea. But I wrote here that at least for me, I will see the partial fill happen like in front of my eyes most of the time when A, my own limit order entry gets partialed, or 2, when my TP gets partialed. So when my entry gets partialed, exactly how I described, if my entry gets partialed and then price starts moving away from my entry. So let's say I'm the one trying to get short, and then I get partially filled short, and then price starts moving in my preferred favor. I'm going to be like, wow, my entry was literally flawless because I went into 0% drawdown. Whatever the rest of my position is, I'm just going to get filled with market orders, and I'll just slam into a market order on the rest of the position. The same goes for taking profit, as I mentioned earlier. So I'm trying to get out of a trade at this level. I get partially filled. Let's say 50% of my position gets filled, and then price starts turning around in the opposite direction. I'm saying, well, hold on. Why am I still long? I don't want to be in this long anymore. Get me out. So I'll just market close out of the rest. And even potentially, it depends, but I could even cut in reverse, flip short, and target whatever the original entry is. The reason why is because so many of the time when my TP has been partialed, there's been let's say this is my entry, this is my TP, price does something like this, my TP gets partialed, and then price turns around. Very high percentage of my trades actually return back to the entry. Therefore, I have this little rule where if my target gets partialed, I'll actually flip short here, and then I will target here, and then my stop loss will be the place where I got partialed, or maybe slightly above the place where I got partialed. All right. Whew. Let me take a small little drink. That's a lot of talking. All right. Question 12. How does one use the mentorship to its fullest? If you have the imaginary conversation with your future A player, how does he make use of your service? Essentially become the best version. So this is relevant to the beta test product or mentorship. And this also is relevant to if you end up not going with me and instead you go to, I don't know, a paid service or paid education with anyone else. This is what I would recommend. So I wrote it here. So the first one is if you can solve your own constraints faster, you're going to make it easier for your coach just in general. So like, yeah, if you give your coach more breathing room, your coach is going to have more time, more available effort and energy to use to like help you hit whatever your goal is. So, oh, not just that, but if your coach can also have that extra time, resources, and energy to help the other people in the community level up as well, if the average baseline of the community that you're in goes up as you interact with the community itself will become more valuable and you'll be able to extract value out of just the community in general. So it's a win-win-win type situation. So that's the first one. The second one, this is an interesting one, is help solve your coach's constraints fast as well. So your coach also has constraints with whatever it is that they're teaching you. So if you join an education service with, I don't know, learning AI automations, or if you join an education service with, I don't know, learning how to play cello, if you help your coach, your mentor, your whatever solve, like you help them get better at their own craft, or you make it easier for them to improve at whatever it is that they're trying to improve at, the byproduct of that is they'll be able to reciprocate to you at a much faster speed, right? Because like, let's say you have a teacher, the more skilled your teacher is, the faster they'll be able to help you with whatever it is, with what you're doing, right? So like if you have a tennis coach, if your tennis coach is literally the number one player in the world compared to, I don't know, someone who's just decent at the local tennis club, it's more likely that the number one player will be able to help you a lot more than the guy who's decent at the local club, not even like state level, but just local level, not even international, not even national, not even state, but just local, right? So if you can help your coach, teacher, mentor, educator, whatever word you want to use, guru, if you help them improve their craft, you will probably improve as well. Okay, next one is if you ask a question and then you get an answer, and let's say this is like you asking a complicated type of question and you get like a complicated type of answer or a lengthy answer, that isn't just like, oh, you should just do X, Y, and Z, like a very simple, straightforward answer. If the answer is not straightforward and the answer was like a long type of answer, what you want to do is you want to say that answer back to your coach or your educator in order to clarify that you actually understood it correctly, like confirm that you get it, because sometimes you're going to misunderstand them. It doesn't mean that you suck. It doesn't mean that they suck. It's just that this is just a natural law of communication. Some of the times when you communicate with someone, some of it is going to be misunderstood. Very natural, very normal. So if a misunderstanding has occurred, you want some process to be able to catch it. So get into the habit of clarifying that you do actually understand the answer that was given to you. And if the coach is good, the coach will normally, if the coach recognizes that they just gave you a vague answer, the coach themselves will ask you, hey, do you actually understand what I said to you? Like, say it back to me. Prove to me that you get it, right? So this is like a little bit on the coach, but like if you want to, take initiative, just say back the thing that the coach just told you to confirm that you understand. And if you don't understand, keep asking until you get it, right? Only until you get it, then move on. So if you do get it, then go and implement it, easy peasy. Okay, and next one. This might be like very biased, but I'll say it anyway. Emotionally validate your coach and try not to complain. So when I say not complain, I'm not saying don't give criticism. That's not what I'm saying. I'm not saying that. I'm saying stuff like, oh, this is so hard. Or like, this sucks. I don't like this. Maybe this isn't for me. Like that kind of language, right? The reason the reason why I say this is because that kind of language, it has a toll. It has a tax on whoever your coach is. The more taxing you are for your coach, the more friction there will be for your coach to help you. So it is within your best interest to make it as as low friction as humanly possible for your coach to work with you. If your coach likes you, I'm not saying like, oh, you have to put on a mask and play this facade. I'm not saying that, but I'm just saying like don't be a negative Nancy. Try to be a positive Peter. It's just like your return on your investment is going to be higher if you be a positive Peter instead of a negative Nancy, right? It's just going to be so much easier for your coach to deal with. And also, if your coach if you happen to uh vibe really well with your coach is literally going to go out of their way to give extra help and extra service for you. This isn't just talking about trading education. This applies to all things. Whether you're trying to learn guitar, you're trying to learn sales from someone, whatever. Be nice to the guy who's trying to actually help you, right? And try not to complain, or try to do as little of that as possible. And that brings me to the last point. I'll use a different color for this one. And this is giving criticism. And remember, this is very different from complaining. Giving criticism is a very good thing, right? Criticism actually helps whoever you're working with improve, right? But there's a good way of giving criticism, and there's a bad way of giving criticism. So a bad way of giving criticism is just by saying, "This sucks. I don't like this. I don't like that. I don't feel good," right? There's no like, it's like, okay, cool that you don't like this. Like, now what? Right? There's nothing good that comes from it. It's just like you're just being negative, and then the negative like thing just gets thrown out there, and there is no solution to it. So a better way to give criticism is to say, I don't like this specific thing because of this other specific reason, right? I think it would be better if we did this instead. So I don't like X for Y reason, and I think it would be better if we did Z or Z, right? So that way you are clearly outlining what you have a problem with, and you're also trying to present some kind of solution. I'll use a different color. Solution-based thinking. Because now when you frame your criticism in this type of format, you're giving a straight line path to the person that you're criticizing on how to actually improve. And this now becomes a win-win. You help the person that you're criticizing get better, they get better, and then they give a better service to you, and you have a better interaction. Win-win. With this one, if you're just complaining, you're negative, and then you make the other person negative too. So whenever possible, try to give some kind of solution or some kind of opinion for how you could maybe approach finding a solution whenever you want to criticize, because it just makes it so much more helpful and so much more efficient. But of course, I understand that not always are you going to have a solution in mind. You might genuinely just like really not like something, but you don't know how to solve it, right? At least if that's the case, and it sometimes will be, you can at least just be like, you could just be upfront about it. You could say, hey, I don't like this, and I actually don't know how to solve it. I'm curious what your thoughts are on how to solve it, and what you think are the ways that we could maybe try and solve this. Again, that's still so much better than, oh, I'm complaining, because then you're putting yourself in this frame of like, yes, I don't like this, but I want to actively work with you to help you find a solution so that we both can benefit, right? So this positive first type of thinking. But yeah, ideally, anytime you have some kind of criticism or some kind of ideas or anything, try to present them with some kind of solution. Because just like pointing at a problem and saying, hey, that's a problem, it's not going to actually make the problem go away. And it's very unlikely, very, very unlikely that you point to a problem and the other person is not aware that it is a problem. It's very likely that, like in a business, I don't know, whatever the business is, you could say like, hey, like this, the line for the bathroom is really long, by the way. The manager of the store probably knows that, right? But if instead you say, hey, if we did blah, blah, blah solution, or like, hey, the bathroom to the line is really long, I tried to think of a solution, but I couldn't think of any. I was wondering what your thoughts are on trying to solve this. That, see how like so much smoother that goes? So yeah, I would recommend that. I hope that answers the question. I'm just thinking, did I miss anything? Oh, and of course, ask. I probably should emphasize this part a lot. Oop. Ask lots of questions. Ask lots and lots and lots of questions. If you ask a question, you will get an answer. Some of those answers are not going to be useful to you, and they're not going to be that impactful to your level of skill. Some of those answers are going to be very impactful to your level of skill and give you very, very big insights. And every time it does, your results improve. And then with a bit of a lag, your skill improves. Your skill improves. And then with a bit of a lag, your results improve too. So therefore, your results are correlated to the number of questions that you ask to some extent, right? So yeah. Oh, and other thing, if you ask a question, try to answer the question yourself before going to whoever your coach or mentor is in whatever service that you're in, because this trains self-sufficiency. Think about it, like whoever you're with, whoever is training you, whether it's in tennis or trading or chess or sport or whatever, whoever is your coach at the time isn't going to be able to answer you 24/7 non-stop all the time. You're going to need to rely on yourself to try to find answers, and occasionally, every now and then, your coach can step in when you're stuck. But try to get into the habit of trying to ask a lot of questions, and also try to answer a lot of your own questions as well, right? Because this is the thing that actually encourages behavior change, i.e. learning, improving at a faster speed. All right, let's keep going. Question 13. Change a behavior in a given condition. So 1, not knowing how to identify conditions, emulating frameworks for finding out conditions. 2, not knowing what behavior leads to a bad outcome. Is it because I trade wrong? Is it because I trade too much? Issue, ignorance. Solution, the skill of asking good questions to find out one's bottleneck. 3, not knowing how to change is a skill deficiency of learning to adapt. What is your take on this, mister? I feel like this was a bit vague. It was a little bit vague, but like I'm going to try to boil this down into what I think this means. I think this is related to like, how can I learn at a faster speed? Or when I do the wrong thing, or when I'm getting the wrong result, when someone is training me, or when I'm just trying to train myself, how can I adapt at a faster speed? So this is a little thing that comes from Alex Hormozi. And there are five main reasons for doing the wrong thing. So doing the wrong behavior in a specific condition. So the first one is they didn't know they were supposed to do it. So like they had no idea on what they were actually supposed to do. The second one is, okay, they did know what they were supposed to do, but they didn't know what done looks like. So they could have partially done it, or they could have done it in the yeah, they could have just partially done it, or they could have done it in a slightly different way, or they were trying to hit the wrong goal, right? So we had to be really clear with what is actually required in order to do the correct behavior. Maybe they do have a clear understanding of what is it that they actually specifically need to do. Not review, okay, like what are we supposed to do? We're supposed to review our journal. What are we, like, how, to what extent do we only review one trade? Do we review 10 trades? Do we review 30 trades? We have to review 30 trades. Review journal. So what do we have to do? We have to review 30 trades. How to do it? What are the exact specific steps that we need to do? So if you don't know how to do it, you might not be able to do it at all. So there could be a skill deficiency. The next one is they know how to do it, like they know how to go through all of this properly, but they just didn't know when it was supposed to be done. So it had to be done by Friday, or I have to do this once per week. I have to review my journal. I have to review the last 30 trades of my journal every Friday or Saturday, right? And then finally, they got blocked because of something else. So I didn't review my journal on Friday. I didn't review 30 trades in my journal on Friday because ... insert reason here. So I did X instead of Y, right? So these are the 5 reasons for doing the incorrect behavior in a specific condition. So if you can if you catch yourself doing the wrong thing, try to troubleshoot which of these it is, right? Then once you've nailed whichever one it is, there is a couple of things that you could do. You could make the thing easier to do. So, wow, 30 trades is way too hard to do. I'm not motivated to do it. Okay, fine. Let's drop it to 20. You could also make the thing more rewarding. So, okay, if you do 20 trades, if you review 20 trades every Friday for 4 consecutive weeks, you get to reward yourself by going to a fancy pantsy restaurant. I don't know, right? But the point is that you really would, if you do something wrong and you're aware that you did something wrong, something in your behavior was incorrect, you want to troubleshoot which of these it is. Is it the what? Is it the specifically what actually had to be completed, like how much of it had to be done? How am I supposed to do it? When was it supposed to be completed? And is there anything else external which is preventing me from completing it that I have to deal with? I hope that answers the question. Okay. Question 14. We have a lot of questions today. We have a lot. All right, question 14. I've noticed a recurring pattern in my work, especially in trading. When I discover something genuinely valuable, for example, a data point or pattern that could materially improve my edge, I get a strong sense of reward and clarity. But right after that, instead of using that energy to go deeper, I feel a strong urge to disengage. It always shows up as wanting to step away, go bathroom, food, talk, do social. Okay, the point here is, this is what this person is asking me. That they're working, and then bang, they get some kind of insight. They get some kind of big aha moment. And then after the aha moment, they kind of just want to chill. They want to relax instead of pushing super duper hard on that insight. Okay, so what he's asking is why this response shows up right after a successful discovery, and how to train myself to stay engaged with that energy long enough to fully extract the value instead of unconsciously escaping the moment. Okay, so why does this happen? Why do we kind of chill out and step back after we get a big aha moment or a big successful discovery? Well, if you think about it, it kind of is the goal of where was it? Where did I put it? Here we go. It's this goal of this iterative feedback loop. We come up with an idea, we collect data on it, we review the data, and then after we review the data, either we get a fantastic new aha moment or it leads nowhere. And just like naturally, it makes sense that most of our ideas will lead nowhere, and a few of our ideas lead somewhere very interesting and give us a genuine aha moment. So it's kind of like winning like a mini jackpot every time we find a successful discovery. Every time this happens, it feels like we finally hit our reward. That literally is the thing that we've been like searching for. It's kind of like you pass the finish line of a giant marathon that you had no idea how long the distance had to be. So like imagine you sign up to a marathon, you sign up to a race, and you're running and running and running, and you have no idea how long this thing is. You've run 1K, you've run 5K, you've run 10K, you've run 15 kilometers now, 17 kilometers. You have no idea when the finish line is. And then finally, after 19 kilometers, the finish line just magically so happens to appear, right? And then bang. This is a very exhausting process. So it makes sense to just want to like relax after you have a breakthrough. Totally makes sense. Totally makes sense. That being said, I love this quote. The best way to solve a problem is to decide that it's not even a problem in the first place. So, what this guy is saying with this question basically is after I find a successful discovery, instead of relaxing, I want to push even harder. Like instead of rest, I want to push even harder. And like I get it. Grind, hustle, culture, David Goggins, stay hard. I get it. I really do. Never finished. Wait, what was it? Job's not finished. Kobe, right? I get like, don't get me wrong. Like I totally get that. Totally get that. Um, but like at the same time, we have to like think about do we really need to solve for this now? Like, is this really the constraint? Is the thing that is holding your progress back the fact that you need to chill for a little bit after you have a breakthrough? Just have a think about that. Of all of the possible problems that you have in your trading or just like in everything that you do at the moment, is really the number one thing that is preventing your growth the fact that you need to rest after a breakthrough? I doubt it. I I highly doubt it. I highly doubt it. Um, so I don't actually think this is a problem. I think it's very natural. I think it's totally natural. Um, Maybe I'm wrong, but this is how I think of work. I think that like as humans, as like throughout the day, we have different levels of energy. So like in the first 8 hours, we sleep, and then we like kind of wake up, and then we have like this peak window of like flow, and then we kind of like taper off from it, or maybe we get into flow again, maybe a little bit here, and then we kind of tinker off a bit, and then we go into rest. So like our energy, or like how much energy we are consuming over a 24-hour period of time, it's not linear, it's not fixed. Like some windows of during some of the day, we are not doing anything, we're just purely resting. And another part of the day, we're going like as hard as we possibly can. And then another section of the day, we're kind of like going at it, but it's not like as hard as we possibly can. Because of this biological fact, I think that lots of things in life are fractal. Um, no, I'm not going into the whole Fibonacci golden sequence theories. No, I'm not. I'm not going into that. What I'm saying is, I think that how I approach work is first I try to calibrate which direction I want to go. Then I sprint. as hard as I can in that direction. Then I rest and I get my energy back. And I want to get as much of my energy back as possible before I recalibrate the direction that I want to go in. Then once I've got maximum energy back, so this is in the how good of a rest I had, I can then use all of that energy to calibrate perfectly. So this is like, or to the best of my ability, because the direction that you decide to run or to sprint is likely going to have the highest impact on the total distance that you travel. Okay, in your preferred direction. Okay, example. So let's say I have a plane, right? This is a beautifully drawn plane. There we go. There's my plane, right? If I get this calibration of which direction I want to go, even if I change the angle, if I pick the direction just slightly different, the actual distance, the difference in the distance traveled might actually be like a pretty large amount, right? Just by getting this angle slightly different, right? If I get the angle really wrong and I travel like at a certain speed in a certain direction, even if I go slightly faster, right? Even if I go 10% faster, there might be like a massive delta between my actual destination and like the actual distance that I traveled. So this might be like 500 kilometers. So picking, like calibrating the direction in which I want to sprint, I really want to get this right. And if I really want to get this right, I want to be doing it from a place where I have maximum energy, maximum resources in terms of time, in terms of my mental state, my mood, my mental energy, my physical energy, like everything. I want everything super duper duper polished. Then once I'm in a really good state, then I sprint as fast as I can in that direction until I have no fuel left in the tank. Then once I have no fuel left in the tank, then I go back into rest, and I use that rest and that calibration time to assess, okay, where the hell am I, right? Where the hell am I? Like, imagine you're flying a plane, but like you have to use a paper map with like topography type stuff, and you have to like look at the stars to like figure out where you are instead of like a GPS, right? It would like I use the logic to like I want to be in the best state of mind so that I can accurately determine or measure where the hell am I. And then from there, depending on where the hell I am, I want to make sure that I'm picking the next direction as accurately as possible. So it's pick the direction, sprint as hard as I can, then rest. So how this is relevant to this is pick the direction, sprint as hard as I can. So that is, I've got the insight, right? I've gotten the breakthrough. And then after I get the breakthrough, I want to rest so that I can pick and think about what am I supposed to do next. And the next thing is I want to be in a really good state of mind of, okay, cool, I've got this successful discovery. How can I extract the most out of it as possible? I don't think that like, I mean, the fact that you do want to step away, the fact that you do want to procrastinate or do anything probably means that you're tired. If you had the energy to keep pushing, or maybe you still have some left in the tank, sure. But the fact that you have to do this means that there's like the tank isn't like full, right? We're working with like a small gas tank here, or there's a little bit left in the gas tank. Even if you were to squeeze it out and you were to like try to push, how effective is that going to be really? Questionable. Maybe the problem here isn't the fact that you're doing this. Maybe it's how are you resting, right? I mean, you said here it's not avoidance because I'm tired or bored, but it's like there there is friction in starting the next thing, right? So yeah, maybe you're not tired, maybe you're not bored, but there's still a lot of energy in like in picking the next thing and being like, okay, this is the next thing that I need to do. But yeah, basically my main point that I want to say is I don't even think that this is a problem in the first place, really. Um, and if you genuinely think that it is, I would not say that this that the rest has to be completely eliminated. I think that maybe how you rest could be changed or optimized. So the rest itself, like what you're doing to rest, might be better to change rather than just simply avoiding rest at all. That's my take. That's my take. Okay, question 15. How can a seasoned trader go into a year's drawdown? This doesn't make sense in my eyes. If your EV is positive, so as in you're a profitable trader, and your frequency is not low, uh, running Monte Carlo, there is no drawdown opportunity. Either his strategy is not EV positive, or he doesn't take enough trades. Why doesn't he just fix his strategy, adjust, or trade more? So the answer is alpha decay is real. Alpha decay is 100% real. Let's replace seasoned trader with seasoned business owner. It's very logical for even very big businesses to have a losing quarter or even a losing year. So think about Blockbuster. Blockbuster was like doing really well, and then Alpha Decay kicked in. A huge competitor joined the market, disrupted the market as a whole, and then they had a losing year. And then even if they were like, okay, well, all the guys in the Blockbuster boardroom, they're sitting there like, okay, we have to change our marketing strategy. Like we just need more leads. Oh, we just need a slightly better we need better customer service, right? Like even if they slightly improved their marketing or improved their customer service or like improved their pricing, it doesn't change the fact that alpha decay is real and their business basically like got nuked. Now, this isn't to say that it's completely game over. It's just to say that it's game over for that specific strategy, right? It's game over just for that strategy. So it's very natural. I would say like it's abnormal for a seasoned trader to go into a year's worth of drawdown. But if it does happen, they really will have to look at and consider like, holy crap, I think I'm getting hit with alpha decay. So there could be like two things that you could go about. The first one is you could we need to actually define like how do we know that we're being hit with alpha decay? And this is like a very big question and there's no like perfect answer to this, but you could say something like, let's say this is the equity curve of your strategy, and then let's say that we have like a moving average with like two standard deviations under whatever this equity curve is. So let's say like this is the moving average. The moving average two standard deviations below this would be something like this, right? And then we could say, okay, if my bankroll drops below this two standard deviations moving average, then I think I'm getting hit with alpha decay and I need to turn the strategy off. So that's one approach for how you could do it. Another approach that you could have is if my P&L is in the red after n units of time, so like let's say 365 days pass and my P&L is still not green, then I think I've been hit with alpha decay. But I think this one is a little bit more reliable than the time-based one, because the time-based one is like, okay, well, how long is too long and how short is too short? It's like, yeah, I don't know. I don't know. Because like in 2018, for example, like if you had like a long only strategy um that does well, right? And then you get hit with a bear market, this strategy could like your logic could just be like, okay, I'm just going to accept that in this entire year, I'm just going to go into drawdown, like a 10% drawdown. So I literally ended red in the year, but I'm down minus 10%. And let's say all the other years you're like up like 80 or 90%. It's like, well, the fact that I ended one year in the red, and the year that I did end in the red, it was a terrible bear market for a, and I'm doing a literal long only strategy. Does it really mean that the alpha has decayed? Not necessarily. If we went into, if the next year was bullish and I still went into drawdown, then it would be like, we have like something's going wrong here. Like the market is not in a bear market and I'm still in a drawdown. Something is going on. But sorry, I'll circle back to the main point, which is it is totally normal to go into a year's worth of drawdown if A, you are just completely out of sync with with the market, or two, if the market conditions have like fundamentally changed to the point of you being hit with alpha decay. So those are the two things. Like either A, you haven't been hit with alpha decay, but like maybe you're just like misinterpreting like your average drawdown stats. So like, oh, okay, actually here you said if you ran a Monte Carlo simulation and the Monte Carlo shows that even like the bottom 50% of Monte Carlo simulations, or like bottom 10% of Monte Carlo simulations don't experience something like this, there might be A, something wrong with the alpha decay, or two, something that you're wrong, something that you're doing wrong in your execution. One of those two things. But this is normal. Like this is normal. But yes, you're right in the sense that if you start getting hit with alpha decay, yes, you absolutely should try to fix the strategy, or change, like nuke the strategy entirely because something fundamentally has changed in the market, and go switch to something else. So like if you run Blockbuster and then you can clearly see that Netflix is taking over, it would make sense to shut it down and then pivot to wherever the edge is, right? I hope that answers this question. I don't know if my answer to this was vague, but I did the best that I can. But yeah, the main point is that this is normal. This applies not just to traders, but to business owners whenever there's like big fundamental shifts in the market. Okay, question 16. Having good plans. Okay, just for this specific question, whoever asked this, I will need you to reword this one for me, because I remember reading this one and thinking like I don't know what the question is exactly with this one. All right, next question. Question 17. Food for thought. Looking at referrals as an independent force of your business gives too much responsibility on us, i.e. clients/students. Rather, training your superfans to do sales for you and get commissions. We are the most convinced about your product because we are the ones who bought and also potentially using us as content. Okay, so I'll explain this point. So if a business is doing less than $1 million per year in revenue or EBITDA, I'll just say revenue for now, just to simplify things. If a business is doing less than $1 million a year in revenue, it's very likely that the main driving force of the business is whatever they're doing for their front end marketing. So like, what are they actually doing to get customers? So at the moment, for me, it would be X/YouTube. It's very unlikely that a business which is on $1 million a year is doing it purely from refs. That would be insane, though. I'm sure there are businesses out there like that, but it's like insanely difficult to get to that kind of point, just mainly from refs, referrals, as in. So yeah, like with me, with an info product or an education type of service, referrals are just a bonus type of thing. They are absolutely not the main driving force of a business like this. It's mainly just like what is the quantity of marketing that I'm doing? So like, what is the frequency? Like how how many times am I actually posting on X and YouTube? So quantity. And then the second one is quality. So like, okay, if I do post on X or I do post on YouTube, how good is that content actually? If we make both of them go up in quantity and quality, I will get more leads. And that's basically like the only thing that someone really just has to think about, at least in this current meta of online business, to get to this point. It's mainly this, right? But I will say with referrals, if a business can get to an average of one referral per one customer, so like let's say if they get 10 customers, if they happen to get 10 referrals from those 10 customers, this is a sign that the product has become really good and the business can achieve linear growth without any front end marketing. So this means if a business can hit this number, one ref per customer, they're going to unlock linear growth. So they could literally completely turn off their front end marketing, completely turn it off, and the business will still grow linearly. And if the business can achieve 1.01 referrals per one customer, then the business is going to go into exponential growth. So this is where it goes like this, crazy growth. So this is like you get 100 customers, and from those 100 customers, you get 110 referrals. So now you have 210 customers, and then those and let's say these finish. Now you have 110. Now those 110 they turn into, what is that, 121, and then these churn, and now you're left with 121, and then so on and so forth. So you get like plus 10, plus 11, plus 12. So now you've basically unlocked exponential growth as soon as you get 1.01 referrals per one customer. But I will say that making a product so good to the point that you hit one referral per one customer, or even 1.01 referrals per one customer, making a product that good, it is an insane feat. It is insanely hard, like insanely hard, because one, you have to make the product super duper 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 good. That's point number one. And then two, you have to attract a super duper perfect super pooper type of customer. So there's like two parts to this equation. Very challenging, very, very challenging, but absolutely not necessary in the early days. Absolutely not necessary. Like under this point, I would say even like under this point, like not even necessary. This is like something that you want to like strive for. Maybe if you want to go for like 50 mil type of revenue, or like 100 mil type revenue. But yeah, definitely, I don't think it's necessary at all if you're just shooting for something like $1 million a year. And then, did I miss anything? Training superfans to do sales. Yeah, I mean, I'm open to this. I'm open to this because I was thinking like I think it's quite common for education services to have their hiring pipeline straight from their own customers. So I think that's perfectly normal to do recruitment literally from the people that are in your community. Like a lot of people on social media do this, and it just makes the onboarding like really smooth because they're already like familiar with your culture, they're already familiar with your community, they're already familiar with pretty much everything. It doesn't just apply to sales, it applies to all types of roles, even little things like assistant, someone doing the marketing for you, someone helping in customer support for you. If they're already a fan of you, and this doesn't just apply to like trading businesses, this applies to all businesses where there's like some kind of community aspect. Hiring straight out of the community is like the lowest friction type of thing to do. So yeah, absolutely. And then this potentially also using us as content. Yeah, 100% I'm going to do this. What I mean, for those who are listening and don't understand this, what I mean by this part is like if I have a one-on-one call with a student, and let's say the student asks me like a really good question and I give a really good answer, I might clip that and then post it as like a short video for X or YouTube. All right, next question. Is this an acceptable duration of regime? So for those who don't know what duration of regime is, it just means how long how long has the regime been going on for? So let's say if price has been staircasing for 1 hour, then it's a 1 hour duration of regime. If price has been staircasing for 17 hours, then it's a 17-hour duration of regime. The longer the duration of regime is, the easier the next trade will be to take, as long as it's in sync with the regime. So if we have a huge downtrend, which looks like this, and it's staircasing down like crazy for a very long period of time, what is that, 10, 12 hours? If the next trade resembles something that looks like a short, it's going to be a lot easier to take than a trade that is a long. So the fact that this person jumped into a short after a 12-hour long staircase is a good thing. So yes, absolutely acceptable duration of regime. Yes, this is a beautiful momentum short. Beautiful. Oh, and what I'll do is in the description, I'll throw in a link for my momentum trading strategy guide. It's a 100-page PDF guide, which goes pretty in depth with how to trade breakouts. But yeah, this guy is pretty much right on the money with, if you have a giant staircase like this, you for sure can get away with just shorting support. And pretty sure at the time, what is this? OP? Yeah, OP USD. This coin basically sold off. So I'm pretty sure this trade ended up winning. All right, next question, question 19. How to set up the tape on Aggo.trade specifically to every coin? Do you have like a calculation that you do based on volume, so it's not firing too quickly, neither too slowly? So my answer to this question was, what you can do is you can look at the average 1-minute volume on Binance, whatever that is in USD, and then divide that number by 100 or by 200, roughly by whatever, like, you're going to have to play around with it, but it's somewhere between 100 and 200. So for example, if a coin is doing, let's say, 100 million per 1 minute, okay, let's say it's doing 10 million per 1 minute, this divided by 100 is 100K. So for example, this is what was happening for Bitcoin. Average 1-minute volume is 10 mil per 1 minute. So that divided by 100 is 100K. So what you would do is on Aggo.trades, this is the tape, Aggo.trade, you would click the settings button. You'd make the minimum 100, like so. And then you would scroll down in this little section, and then you just make sure that the minimum for a trade to trigger a sound, you also set that to the same number here. I say this because by default, these two numbers are different. So you just want to make sure that they're synced up. Otherwise, it just gets really confusing. Okay, next question. Question 20. We have just a little bit more to go. My trading account is more than 50K now. Do I have to trade more careful while scaling to 100K or switch to HTF? Higher timeframes. This is what this guy's asking. Okay, so the first thing is you're going to have to monitor your slippage per trade, because when you're trading with a 50K size, this is when, and if you're on the 1 minute time frame, you might start getting hit by slippage a little bit more frequently than if you were like at 20K size before. So you're going to have to start monitoring your slippage per trade. So in your trading journal, you might want to add a column, and you just want to call it slippage. And in that column, you just want to write every single time you get hit with slippage, just write whatever that number is. And make sure that you get a good feeling for what is your actual average slippage per trade. And if this number starts creeping higher and higher and higher, you might want to reduce your size before you can address it. So the first step is you want to start tracking or monitoring your slippage per trade in your journal. After you start monitoring it, the next thing is you want to try to reduce your average slippage per trade. So there's a couple of ways to do this. The easiest immediate way to do this is to execute the exact same trade, but on multiple exchanges at the same time. Why? Because when you're using multiple exchanges for the exact same trade, you get access to more liquidity, as in like more limit orders with your market orders. So you can spread your market orders between multiple exchanges. Therefore, your slippage goes down on the exact same trade. So this is like the easiest thing that you could do to instantly drop your slippage. just trade on multiple exchanges. The second thing is TWAP. This stands for time weighted average price. What it basically means is that let's go into this example. Let's say that we wanted to execute this trade with 100K size. And we wanted to enter with 100K. We don't have to enter click a single time with 100K as soon as our entry condition is met. What we can do is we can enter with 30K slightly before the trigger, because if it's so close, like if the trade is so close to triggering the entry conditions, like the closer it is to triggering the conditions, the more likely the trade is actually going to confirm versus fake out, right? So as it gets closer, like really close, you can already put on like a starting position, like slightly earlier before you even enter the trade. And let's say this is like 30K or 33K. Let's just pretend 33. Then as it confirms, you can throw on another 33K. And then maybe like one candle after you've entered the trade, you can throw on the final 33K. And then average price of your entry is going to be the exact same as if you entered normally, right? So you get the exact same entry price, but the average slippage per every single one of these orders is going to be lower because you're hitting 33K against whatever is in the order book at the time. Then again, you hit 33K with what's like available at the time, and then again you hit 33K. So like average slippage, let's say per one of these orders could be like 1 basis point, 1 basis point, 1 basis point. So your average slippage per trade would be 1 BPS. But if you hit in with the full 100K, like you hit in full 100K market sell, like at the time when you get your entry and you just market sell 100K, you might get slipped like 10 basis points, right? Like 0.1% in slippage. This is, for those who don't know, 0.1% is 1 basis point, 1 BPS. This is just easier to say than 0.01%, right? So 1 BPS. Okay, so that's one thing that you could do. An alternative thing that you could do is once you get your trigger to enter the trade, you could split your 100K order into 100 $1,000 orders, or even more crazy, $1,000 $100 orders, and they're all going to be executed over a 60-second period of time, right? So it's like rapid fire $100 orders over the next 60 seconds. This can often, not always, but often, this can reduce your slippage per trade because a lot of market makers, because not on all coins there's not just one market maker, there's often like more than one player who is making the market. If there happens to be more than one player who's making the market, sometimes whoever is making or whoever the entity is that is making it doesn't have their bot as so sophisticated to detect a TWAP, and what will happen is the market maker will go and quote, let's say, a $1,000 order, and then you hit it with a $100 order, so then 1,000 gets dropped to 900, and then after it drops to 900, they just refresh it again back up to 1,000. So you can basically get filled for your desired price. You can get filled for a larger of your desired position size for your desired price, compared to if you just slam in 100K, you're just going to slip the book, right? You won't be able to take advantage of the fact that there might be an unsophisticated market maker who is refreshing their orders, because a lot of the time when a market maker does get partially filled, they will just refill whatever was partially filled with their order. So that's another way. Then I'm pretty sure there are tools where you could like randomize your orders to make it harder to detect that there's a TWAP. So it could be, I'm going to execute a trade. I'm going to execute a 100K position over the next 60 seconds. but the timing of the orders isn't going to be every 1 second. It's going to be every n seconds, where n is a number between 1 and 5, and it's randomized. And also, the position size that I'm going to get between these 1 to 5 seconds, it's going to be a random number between 100 and, let's say, 1000. And then by the time that we get to the 58th second, on the last 2 seconds, we're just going to mark it. We're just going to mark it by whatever the remainder is of whatever is left to fill, basically. So we get slipped quite heavily on, or we get slipped harder on the final 2 seconds, and then we get, just so that we can get the last of the position size on. But in the first 58 seconds, we're basically playing with whoever is market making, right? We're trying to get filled for as much as possible without the market maker realizing that it's just one entity who is entering a large position. If the market maker is in-house, they 100% will know, and they will adjust their quotes accordingly, meaning you will get slipped the normal size. But if it's a third-party market maker, it will be harder for them to tell, and they won't adjust their quotes as quickly, and you'll be able to get filled for a much larger size. So yeah, that's reducing slippage. Okay, another one. This is an interesting one. You can try to reduce your costs. So this is if you have a friend, like before you sign up to any exchange, if you happen to have friends who are on that exchange, you want to ask them for a referral link so that you can get a discount on your fees, because most exchanges will offer discounts on fees if you can get onto a referral link, right? This isn't me shilling my referral link. I'm saying, like, I don't need your referral. I don't need your referral link coins, your referral shekels. I'm saying go to your friends, okay? Go to your friends and ask your friends for a referral link so that both of you can benefit, okay? Go to your friends, ask for a referral link, and use your friends. This applies to like most exchanges. So that's the first thing that you could do. The next one, and this is another reason why marketing is a big deal, and I think I mentioned this before, is that if you have some kind of brand on Twitter, on YouTube, on whatever, you can get a deal with the exchange to promote them in exchange for lower fees. So building a brand building a brand as a trader is so worth it. It's like so ridiculously like EV positive. It's not even funny. So absolutely would recommend growing your Twitter account or growing your YouTube, whatever, Instagram, so that you can get discounts on your fees with whatever exchange that you're on in exchange for promoting them. Okay, if you've already done all this, you're tracking your slippage, you are trading on multiple exchanges at the same time, you are trying to get your execution down like really, really polished to really reduce your slippage per trade. If you've done all that, and you've tried to get the referrals and the deals with exchanges, whatever, the only real thing that you can do beyond that is you're just going to have to find new alpha, right? You're just going to have to find new edges, new strategies which have a low correlation to whatever it is that you're doing currently, so that you can trade it simultaneously with whatever it is that you're doing at the moment. So for example, if you have a momentum long strategy and if you have a style for trading momentum or trend following, or if you have a style for trading mean reversion or reversals, so you have one strategy for breakouts, you have another strategy for reversals. Both of these strategies are dependent on price moving up or down. So you could look into developing a strategy which is not related with price moving up or down, but related to something else moving up or down. So for example, funding arbitrage, price arbitrage, right? So completely new type of strategy. Alternatively, you could test if your current strategies of trading, if they work in new data sets. So what I mean by this is, does your current strategy does it work in different markets? So if you trade altcoin perps, do you know if your strategy will work in equities? Do you know if your strategy will work in Forex or commodities, right? You want to test it. You want to see, because if it does, what happens? You're going to get more positive EV trades. You're going to get more good trades. You're going to make more money. So you want to test if it works in different markets. And you also want to test if it works in different time frames as well. But quick disclaimer with this one. This is going to be somewhat correlated to what you already do. So careful with this one. A bit careful with this one. Like, yeah, it's still going to work, but like, what I mean is, if you are long, like, let's say this is Pepe, right? And let's say this is the 5-minute time frame on Pepe, and you just got long. You don't want to jump on the 1-minute time frame and then jump into the same exact breakout long just because, oh, it's a different time frame, therefore it's a different trade. That's not what I'm saying. I'm saying, like, okay, maybe a coin doesn't have enough volume on the 1-minute time frame, but it does have enough volume on the 5-minute time frame. So you can take the exact same coin, the exact same trade on the exact same coin, but just different time frame, and just set the expectation that your trade is probably going to play out 5 times longer than normal. So if your average trade duration is 1 hour, right, on the 1-minute time frame, and you take the exact same trade on the 5-minute time frame, then it might take 5 hours before price goes and hits your target, right? But you can still do that. So you can absolutely do that and experiment like that. That way you can still get more trades without destroying yourself to slippage. But yeah, basically, the road from 50 to 100K, you don't have to switch timeframes. Like, you don't have to. It's just that you're going to have to really pay attention to your slippage and make sure that you're not destroying yourself to it. That's it. So pay attention to your slippage, try to reduce it over time, try to reduce your costs over time, and naturally you're going to have to go and look for more types of edges as well. All right, next question. Question 21. Hey, Spicy, one question keeps popping up in my mind. Momentum longs. Okay, what this guy is saying is, if we have, I won't read out the entire thing. I'll explain it. What this guy's asking is, if we have a super, super nice staircase, super nice price action, perfect for trading momentum, why can't we just enter the trade before it hits a level, since it's unlikely that the thing is just going to collapse? And can't we just take profit at the level, since these are the levels where price ends up massively reverting anyway? So why can't we just enter blindly, like, in the middle of nowhere, and just take profit at the level? So you absolutely can. Oh, and disclaimer, these are not real trades. So you absolutely can do this. 100% you absolutely can do this. But, and this is a big one, the quality of the trade has to be high. So the higher the quality of the trade, the higher your margin of error is going to be. That means that the more you can get away with, because the further away from a level that you enter, the higher your slippage is going to be on your entry, right? And also, the lower the chance will be of you being fully filled if you were to try to enter on a limit order. So if I was to just randomly market buy here, it's more likely that I'm going to slip the book compared to if I tried to enter here at this resistance level, because there are limit orders here. There's a lot of limit orders that are stacked here. So if I'm market buying into this level, my slippage is going to be lower. If I'm market buying in the middle of nowhere, I'm probably going to slip the book a little bit harder, right? So the further away I'm entering from a level, the bigger my slippage will be. The closer I'm entering to the level, the lower my slippage will be. Okay, if I'm trying to enter on a limit order in the middle of nowhere on a super, super nice trend, it's unlikely that I'm going to get filled because there is so much market buy pressure that is coming in. So I'm probably going to get partially filled. And if I do get fully filled, in the times that I do get fully filled, it's probably if in that small instance that the whole thing decides to collapse. Comparatively to if I'm just bidding a retest it's going to be a little bit easier. It's going to be a little bit easier since there are traders here who are going to be actively looking to market sell. Because remember, if I'm entering with a limit order, how can I get filled? I need people willing to trade, willing to sell into me, right? So if I need people to sell into the order, I need to be trading at a location where people are willing to sell, i.e. a support or resistance level. So yeah, the main point is that you absolutely can do this, but for lower quality trades, it's not worth doing because every time that you blindly enter like this, you're going to get more frequency, but there are going to be higher costs in doing this, right? So it's only worth it. It's only worth it if you have something really clean like this, because the P&L from all of these winning trades, it outweighs the costs of the slippage. Okay, so yes, you can do this, but not on low quality trades. Okay, next question, question 22. Do you use funding rates as an input to make a go or no-go entry decision? Well, luckily in my latest mean reversion trading guide on page 92, I actually cover this. So I'll just quickly I go more in detail in the guide, but I'll just quickly write it. If the size of the funding payment is going to be larger than 0.1 R of my trade, and the funding payment will come within the next 90 minutes, I will not take the trade. Why? Because if the funding payment will come in the next 90 minutes and it's larger than 0.1 R of my trade, I'm just going to randomly lose an entire 0.1 R to a random funding payment. So I don't want that. If the funding payment is less than this number, then I'm totally fine with that. I'm totally fine to pay that, not a problem. If the funding payment is going to come after 90 minutes, I'm also fine with that because I'm going to be out of the trade within like 60 minutes anyway. And if let's say the funding payment is in 91 minutes and I'm already stuck in the trade for 90 minutes, I can just close out of the trade pretty peacefully, pretty calmly, because my average winner doesn't go for this long. So I'm totally fine to close out a little bit early just to avoid the funding payment. So for quick context, usually I will close out of the trade if I'm stuck in it for 120 minutes. But if there happens to be like a big funding payment, I'm okay to close out after 90 because my average trade is only 60 minutes. Okay, next question, 23. Seems like a leverage in marketing, yeah? I remember when the first time I follow your account, it was under 10K followers, and now it's nearly 20K. I was like, bruh, this guy has a vision. This isn't normal, until I found you make a daily updates on YouTube. So are you investing almost 100% of your time on this, which you know what you are doing? Okay, so yes, I'm like currently 100% of my time right now is on building my brand. So 100% of that is just on brand. I'm not trading at all. Like right now, I am not taking any trades. Not a single one. Zero. Nada. And I won't be trading again until I actually launch the beta test product. Why? Because my constraint right now is that I don't have a product which generates money from my crypto brand. And my revenue is stuck at zero. So as soon as this number switches and moves out from zero hell, and I start making money from my brand, or at least, when the beta test launches, that's when I'm going to start trading again. Because as soon as this launches, I'm going to start trading again, since I want the live trade examples to literally be a part of the product, right? I want to share my charts. I want to share my live trades. I want to share my live takes on the market, because this is actually going to assist the active traders of the community, and this is like one of the things that is going to help improve the community, right? Someone out there in the community has to be posting charts, trades, or takes on the market on a daily basis to kind of set the standard. And who better to set this standard apart from the owner of the business, right? Think about it. If the owner of the business is not doing something, then they're not really setting the example for the community. And this is totally fine if there's someone else in the community who's already doing it. But if that does not exist, it has to come into existence. So the owner or someone else in the community has to immediately start doing it, right? And since I'm a one-man army, it has to be me. Okay. Question 24. Hey Spicy, I've seen your recent YouTube videos. They're great stuff. Since we work in the same business, I'd like to get one clarification regarding your Telegram channel. What is the point of your Telegram channel? X is the primary source of your marketing and you monetize it. Your Telegram will most likely be filled with people who are already among your X followers. Most big CT accounts just forward the same X tweets into their free Telegram without any further context. It's a dead end. So what are your plans with it? Are you also planning a Discord? How will it differ from the Telegram? Do you plan to monetize either or both in the future? If yes, how? Okay. So quick context. I don't actually monetize my X at the moment. So like I'm not on the monetization program or whatever that thing is where you get paid for your views. On X, I'm not trying to rack up views. I'm trying to rack up bookmarks. I'm trying to give value to the right number of people. I'm not trying to go viral, right? If I post a video of like someone punching a grandma or like, I don't know, Logan Paul doing a backflip and then face planting and then getting a pie thrown at him, it will go viral. But like, it doesn't matter if it goes viral because none of those people who will click follow on my account have anything to do with trading, right? So I don't care for that. So I'm not actually monetizing my X for the views. I'm just trying to attract the right kind of people. So that means that the total number of views that I have will go down, but that's totally fine because it's compensated by the quality of the viewer or the quality of the follower, right? So I'm not posting memes, I'm posting valuable stuff to attract the right type of people. So that's the first thing that I want to say. And then technically, I'm not monetized at all because my revenue is 0 and my profit at the moment is 0. Most big CT accounts just forward the same X tweets into their free Telegram. It's a dead end. So yeah, this is like where someone will post like a thread or an article and then they just post the exact same thread or article into their Telegram to pull the same people to like hit them twice basically with the same content to boost the engagement on that particular thing. Totally fine. I have nothing wrong with it. I have nothing against others doing that. Here's my take on how I want to do it. So X or Twitter, this is for my cold audience. So this is for people who do not know me. So this is where I'm going to be posting low effort stuff or at best things that I want to try on. At best a video or an article, right? So I'm posting for people who don't know me. Since 97% of people who view my content on X, they don't follow me. And this applies to most people, I believe. So like if you post on X, 97% of the people who see your stuff, they don't follow you. Only 3% of your followers actually see your content, okay? Then the Telegram, the stuff that I post in here, this is for my warm audience. So this is like high effort stuff. This is where I'm going to be posting my super duper in-depth PDFs. This is where I'm going to be posting custom or personalized stuff for the audience. This is where I'm going to be posting charts, my takes on the market, etc. You might think like, hold on, why can't you just post charts and takes on the market and live trades? Why can't we just post that on Twitter? And the reason is because charts and takes on the market or any like whatever my opinion is on the market, it performs terribly on Twitter. Why? Because the people who see it, they have no idea who I am. And if they have no idea who I am, they have no reason to listen to me. So I'm basically just posting charts in the void. And I did this for an incredibly long period of time before realizing that, oh, I think charts are actually not good for Twitter. They're much better for Telegram, or they're much better for a warm community rather than a cold audience. So all the charts, trades, all of that stuff, I'm going to be posting into Telegram, not on Twitter. And then how it's going to be different from Discord? Well, Discord is not going to be free, except during the beta test, of course. This is where you're not going to be just seeing my messages, but you're also going to be seeing messages from other people in the community. But this isn't like random people in a community. This is like gatekept. It's going to be highly, highly gatekept and expensive. So this is only for like serious people who are really willing to commit, right? So those type of people. So it's going to be a very small group of people, but the quality per one person is going to be very high. So small community of high level type thinkers, I should say, accountability. So in the Telegram, I just post stuff randomly. I'm not like DMing people hardcore, like keeping them accountable, hardcore giving them personalized advice, personalized feedback, super customized. Like that is not happening on Telegram or Twitter, but on Discord, it's going to be very, very like one-on-one type stuff with the community as well. All right, and then last question. This is the most important one of them all. I had to wrap it up with this one, which is, why are you gay? So to the person who asked me this question, I'm very sorry to disappoint you, but I'm actually not. So yeah, my apologies, good sir. Oof. All right, so that wraps up the huge, hypermassive Q&A. So now let's go into the progress update. Wow, I have so many drawings here. Okay, progress update. So Twitter growth is very slow. I've been posting a lot less lately. So posts dropped by 50%. So naturally, impressions dropped by 50%, and profile clicks dropped by 50%. Who would have thought that if you do something twice, 2 times less, you get 2 times worse the results? So totally expected. And in the same way, if I was to double my posts, I would probably get double the impressions and double the clicks and also double the followers. But I'm not stressed about this because the main problem that I'm trying to solve for, it is not followers. We have already solved this problem by getting X in a really clean and systematized manner. So what I've done is I've sacrificed some of the efficiency of X in exchange to move at a faster speed on whatever the next problem was. The next thing that I was really working on was my mean reversion trading strategy guide, which I managed to complete, and I'm very happy about that. Telegram stats, I'm now at more than 1,000 members, so that's really good. Yeah, Twitter growth was basically flatlined, and then it started to grow again every time I came close to like releasing something. Same with Telegram. Telegram was basically flatlined until I teased that I was about to release something, the mean reversion guide, and actually did release the mean reversion guide. So yeah, Telegram growth is fine. And now the next thing that I'm going to be working on is a custom trading journal and a custom daily report card. So most of my focus is now going to be on completing these two things, and then I'm going to be posting them into the Telegram. And okay, so that is the update. And then do I have any strategies or tactics or extra thoughts? To be honest, for this episode, not really. Just because like I went through so many questions. I just really wanted to get through like a whole bunch of like unread questions that I had. Now that I got through them, I'm pretty happy. In terms of like what I really am just thinking about, I'm not even really thinking about anything, to be honest. My mind is blank. I just have to get through these two. I think this is fairly low effort. As soon as these two things are done, I'm actually quite excited for what happens next. As soon as the journal and the report card are done, that's when I'm going to launch the main YouTube channel. So it's going to be separate from this one, and it's going to be purely just for trading education. And I'm quite excited about that because after the first 3 videos are done, I have a super crazy project that I'm going to be working on. All right, that is it. That is everything. So yeah, I'm currently on day 29, 0 revenue, 0 profit, but it won't be like that for too much longer. I expect these numbers to start going up soon. All right, I can wrap up here. If you're still watching, thank you for watching. And if you have any questions, just drop them into the comments or in my DMs. All right, thank you.